I'd like to discuss our Elliot two-wave Fibonacci pullback system. This is a trend trading system that finds explosive trends and gets into these trends after a two-wave pullback. One of the mistakes that many new traders do, they try to trade with the trend, the market shoots up and they buy the highs, and then the market pulls back and they get out with a loss right before it shoots up again. Rules. First, find an explosive trend. You can do this using our currency meter, our FX Total View quote sheet hot list that has the real-time trends. Then you wait for a two-wave pullback. What this means is if the market shoots up, you wait for it to come down a little bit, maybe try to go back up again, fail, and then on the second move down, wait for the Fibonacci profit target level to get hit, and then enter. The stronger the trend, the more likely the 1.382 fib profit target level is going to be where you get in. And if the previous trend was not as intense, then it's more likely to hit the 1.618 Fibonacci profit target. I'll be going over examples in a minute. So you enter the trade at the fib targets, whether you use our trend line entry method or if it comes down to these fib profit targets and goes sideways when it breaks out in the direction of the major trend, then you get in. For exits, your initial stop just gets put beyond where that second wave swing high and low is, and then you use a trailing stop, and I highly recommend using Fibonacci profit targets in the direction of the previous trend to find likely stall areas where you would exit your trade. Here we have the euro dollar. Yesterday it made an explosive move up, and there was really no pullback whatsoever. The market just went sideways. Today, again, it exploded up. And notice the real-time trend is over the 20. This is our trend explosion system. A lot of traders would have bought this little flag breakout right here and rode it up another 30 pips here. But my two-wave pullback system looks for a wave down, and either it goes sideways after the first wave or pulls back a little bit like this one does. You draw your fibs on this, and when it gets down to the Fibonacci profit target level, this is where you enter into the direction of the trend, which is up. So it went up, pulls back again, two waves down, you get in near the first or second fib target. Notice the intensity of the down move was nothing, not even near our 20 level, and 1/3 or 1/4 as much as the intensity of the up move. Your stop would be right underneath this low. Let's look at this on a 50 tick chart, which can oftentimes give you a lot cleaner view of these two-wave pullbacks. Okay, here's the euro dollar with a 50 tick chart. Clearly on a 50 tick chart, after it exploded up here, a lot of traders would have got into this based on a triangle explosion pattern here. Then the market continued on up again, and then it pulled back, and you can see you draw your fibs from the top down to here, and you look to get in somewhere between the 1.382 and 1.68 fib target. When it comes down, it either consolidates and then starts to go back up. You might have entered here or underneath here. If you're a scalper, when it looked like it wasn't going to go higher, you might have exited this trade with a few pips and got back in it again here for a few pips. This is the trend line entry method right here, where it comes down. As soon as it's in this range and breaks that trend line, you get in. And you know, whether you trade this as a scalper for a few pips, or you get in and use the longer time frame charts to keep you in as long as possible, you can see this went from around 42.15 all the way up to around 55 for a 40 pip move. Here's the pound dollar. Again, this one exploded up. Our daily, weekly, monthly trend on the bottom is clearly strong and up, and it went above our upper containment band. And then you simply wait for a two-wave pullback. A lot of traders, when they see these strong trends, they wait for a little bit of a pullback and they get in, and then the market comes down, stops them out, and then explodes up, and they're on the sidelines. That's a horrible thing to have happen to a trader. So let's look at this on a 50 tick chart. You can also use a 2-minute chart as well. You see the previous swing up. Obviously this exploded up, and then you simply wait for a two-wave pullback. The market kind of double topped right up here. You can see a lot more clarity on tick charts than you can minute charts. And then on the pullback, you wait for either the 1.382 or 1.618 to get hit. And if it hits this level and kind of consolidates right here, you'd wait for it to break out of the bar's high to get in, or in this case it went down a little bit lower. Aggressive traders might just get in it right near the 1.618. That oftentimes works when you have a really strong trend up. Or you wait for it to break this little consolidation and you're long this trade around 62.46. And you can see this trend did continue and it went back up another 10, 20, 30 or so pips. In fact, this one also had another entry in this earlier today. The market went up and you can see started to pull back, and you draw your fibs on here, and you might have decided to get in right here and you would have had a loss. And then again, when it hits a 1.618, that's frequently the end of the move. You get back in here, and then the market took off, and you can see it went up 50, 100, 125 pips. Here's another example. Australian dollar, very strong uptrend. Daily, weekly, and monthly trend extremely strong, plus 20 strength. You wait for a two-wave pullback before getting in. You know, the high was at 6 o'clock. We're going to look at this at 6 o'clock on the Australian dollar. Okay, so the market exploded up. You have a pullback from here to here. You draw your fibs on there, and if it stalled here at the first fib level, went sideways and then broke out, you'd go long. You might have decided to get in this trade right here, and depending on where you put your stops, I usually put them a few pips underneath the low or even underneath the 1.618 fib level. You may or may not have been stopped out initially on this trade depending on how far your stop was away. Again, this is less than a 10 pip stop here, so if you had a 10 pip stop you would not have been stopped out. You could wait for the little wedge pattern to break out or our IntelliTrend bars to go green, and you can see it started to continue its trend back up. It went from 90 all the way back up to 40. So that's a 50 pip move. It causes and ensures traders are patient and disciplined. You know, big move up, two-wave pullback down. 1, 2, Fibonacci profit target levels are usually where the two-wave pullback counter trend move stops, and then the trend oftentimes continues. Now, it doesn't always break out and go up like this. Sometimes it goes halfway back up to the highs. Other times it goes back up to the highs, double tops, and that's the high of the day, and then it comes crashing down. But regardless, this is a good entry method into the trend, and it causes you to be patient and not get in too soon. You know, if you had bought this little pullback right here, it only went up about 10 pips. If you bought this little first pullback right here, it went up less than 10 pips. You bought this one after a two-wave pullback, it went up 50 pips. That's the difference. Here's another one, New Zealand dollar, super strong, one of the strongest daily trends, one of the strongest weekly trends, one of the strongest monthly trends. So if you had seen this trend up and bought this little wedge pattern right here, and only went up 10 pips. If you had bought the first pullback down, it didn't even go up 10 pips. But if you had drawn the Fibonacci's on the first swing down and waited for the Fibonacci profit targets in the two-wave counter trend move, and you can either draw your trend lines over the bar's high like we discussed in another video, or just simply wait and see if the 1.382 or 1.618 fib profit targets get hit and stall the price. When it breaks out, you get in, and you can see this shot up 10, 20, 30, 40 pips. And then it had a pullback and it went up another couple pips. So whether you were in that trade and used the previous swing move to decide where to get out of that trade and you hung on to the Fibonacci profit targets, or you just simply trailed your stop up and got out somewhere up here, regardless, it was a good trade. Here's the New Zealand yen. Again, very strong, high intensity, daily, weekly, monthly trend, super strong. So you see this explosive move up, and it's up a lot. You wait for the first move down. This is a counter trend move in the direction opposite of the prevailing trend. And you wait for the second wave down. And again, most of the time the 1.618 is going to be the lowest that it goes. If it shoots down way below that, then you might decide not to take this trade. But if it stalls at the 1.382 or 1.618 Fibonacci profit targets, then it's much more likely to continue back up, maybe stalling halfway up or at the previous swing high, or in this case 10 pips higher than that. You could draw your trend lines over the bars high. When it breaks, get long or wait for the IntelliTrend bars to go green. Regardless, you get in, your stop's right underneath the low here, and it works its way up, and when it goes sideways up here, this is oftentimes the end of the move, and you get out. In this case, it went up about 25 pips.